welcome back. We are moving on to our next panel now, alternative property investments. So we've heard a bit about offices today. We've heard a bit about industrial and logistics and retail. So now we're going to talk about alternatives. So I'd like to introduce our panel. So we have Matthew Norris, Head of Real Estate Securities at Gravis Capital, and we have Jason Baggaley, Fund Manager of Aberdeen Property Income Trust. We were supposed to have a third panelist from Civitas, but for obvious reasons, they can't make it today. So I think we'll just dive straight into it. Afternoon, guys. Hello. Right, so like I said, the three main property sectors we sort of touched on today. So I thought it'd be really interesting to talk about the alternative property sectors, as it's called. So things like self-storage, student accommodation, things like that, and get to know why investors are looking at that, what the benefits are of it, and the pitfalls, I suppose, as well. So I just did a bit of digging around before we started. So alternatives, as it's called, has grown from about 12% of the total property investment 10 years ago to around 27% in last year. So first of all, Matthew, what do you think is behind this shift?
Yeah, look, really interesting question. So definitely a shift into alternatives. I think if we think about alternatives, what are they? Through the Gravis lens, one of the mega trends that we invest in that's clearly alternative is aging population. So it's healthcare assets, it's GP surgeries, it's care homes. Why has that grown? It's because there's massive demand for that space. In the UK, the over 85s is the fastest growing population cohort in this country. It's set to double in the next couple of decades. A massive demand in that space. Another alternatives area that we invest in is we call it generation rent. The mega trend generation rent is purpose built student accommodation. It's the build to rent sector. So students going to university now, they're far different to when I went to university. I was the fifth guy in a 4-bedroom house. So I slept in the dining room. My daughter's about to go to university. She wants ensuite, purpose built, and it's going to cost daddy a lot of money. It's clearly changed. So you see this evolution taking place. The mega trends are there. The demographics are there. We heard earlier about the shift to online shopping, the digital natives that are becoming an increasingly larger percentage of the population. That trend is setting in place and is going to run for many years to come. Jason, do you have thoughts on the growing trends?
Yeah, I think it's wrong to talk about the three main sectors today. So I'm not sure that retail would make it in there if you are. Yeah, so there's been significant change, and I think we've seen a move towards operational real estate. So landlords providing a service as well as a property, an asset, and as part of that, a professionalization of the investment opportunity. So if you go back 15 years or even longer, when I was at university, I mean, you could buy a couple of old terraced houses and let them up. There wasn't a purpose-built student market. And so we've seen a huge change in the availability of investment range because we've changed the way we operate, what we're prepared to invest in. And I guess we've learned a lot. It used to be, say, having 100 tenants in a building meant that you had really disparate rent and lots of risk. Actually, what's been the most consistent form of rental income through the recession or the COVID, etc., is from residential with 100 tenants in the building. So I think there's been a big change in mindset as to what a good quality, stable, growing income can look like.
Yeah, I think you touched on a really interesting point that the market sort of evolved. The old-fashioned real estate market, the traditional, was the landlord tenant model, the let and forget model. We're now in an owner operator part of the business where if you look at generation rent, certainly Unite Student it's a REIT, owns purpose-built student accommodation. They develop the assets, they brand the asset on the outside. It says Unite Student on the building. They have their staff in the buildings that are operating it. They have the digital front end as well. So they've made that big investment into that space. Self-storage. So still self-storage, clearly an alternative part of real estate. It's delivered fantastic returns to shareholders over the last decade, set to continue to deliver fantastic returns. An owner-operator model, big yellow self-storage. I'm sure we're all familiar with the big yellow assets when you're driving along an A road into a major town. You see the yellow building, branded big yellow, their staff inside the building. They've got the digital front end. That's all fueling the growth of these alternative sectors.
Mm. Well, you two have got different approaches to this, I suppose, because Matthew, your fund looks at, like you said, the mega trends and invests in listed real estate companies that follow those trends. Jason, you've got a diversified portfolio which includes alternative assets. So what do you look for in your asset allocation?
So I'd say probably what we do is not terribly different, apart from the fact I invest in direct assets following thematics and then applying a bottom-up approach, just as opposed to investing in REITs following the same type of thing. So we are investing in a direct portfolio. So we own the asset, we control the asset. The reason for investing in alternatives within that portfolio is partly diversification, lack of correlation to something existing, partly investable universe of what I believe will give good returns. So structural changes are a big driver over medium to long term, and real estate is a medium to long term investment horizon. So as we came out of retail 15 years ago, where do we replace the money? Well, it's got to be in somewhere we believe is going to provide some growth. So growth in rents, capital value appreciation, and increasingly that's been alternatives. Data centers we haven't yet mentioned, but we bought a data center a few years ago. I can remember at the time one of the board members saying, but surely with the cloud, there won't be a physical data center, it'll be out of fashion. So of course you have to define what the cloud really is. And you realize that data centers have a huge growth trajectory in demand. Some challenges around ESG, and I'm sure we'll come on to the impact of that in alternatives.
So it's interesting this approach. So Jason's right that we both identify these key mega trends that are taking place. At Gravis, we invest in the UK listed property fund. We invest in 24 REITs. Those 24 REITs fit into one of the 4 mega trends: the aging population, generation rent, digitalization, or urbanization. Those 24 REITs, real estate operating companies, own about 5,000 buildings and have more than 100,000 rent-paying tenants. We get huge diversification. And as Jason says, the old model, the traditional model of real estate was what's the credit quality of your tenant like? And there's great weight put on. If you had in the old days, if you had Debenhams as your tenant, that was great. But, these are long gone. But contrast that with what we saw during the pandemic in generation rent. So thousands of individuals, couples and families renting apartments on an individual basis. They won't have the AAA credit rating, but they're going to cut many things before they don't pay the rent on their home. They've paid the rent. And then you see some of the landlords in purpose-built student accommodation, they ripped up the tenant agreements because they took the long-term approach and said, look, the students aren't there. If you're not there, don't bother paying us the rent. They worry about the purpose-built student accommodation REITs, worry about their brand value and the long-term dynamics. Students are back, they're paying the rent. And actually, generation rent is probably where we're going to see the fastest rental growth across the UK.
That's interesting because we're in the listed, we have Granger, we have PRS REIT, then I start to struggle to think of any more sort of specialists in that sector. Do you think there's scope for more?
Yeah, it'd be great to have more. So yeah, definitely Granger owning mid-market apartment buildings, absolutely first-class owner, developer, operator of those assets. PRS REIT owning family homes, 5,000 family homes around the UK. So is there scope for more? Yes. I mean, the problem right now is REITs are on sale. UK REITs are at bargain prices. We saw on the slides earlier, the slides that you put up, they're trading at significant discounts to net asset value, so 20-30% discount to net asset value. So how do you launch a new REIT today at NAV when investors like Gravis can buy an existing one at a 20 or 30% discount? I think that's clearly a challenge. In generation rent, I think student accommodation, Gravis used to run TCP Student. It was acquired by private equity. Private equity get it. I mean, there's great growth here. When REITs trade cheaply as they are right now, you'll see M&A. So it'd be great to see more REITs coming to the market. I fear, well, actually, some of them will get acquired. We saw private equity at the beginning of April acquire Industrials REIT. I mean, there's a shrinkage going on out there.
Yeah, it's been a theme throughout the day, isn't it? But this will probably happen. I was interested to hear Ollie say about there needs to be this consolidation within the sector so we can get bigger, more cost-effective companies. Do you see that happening?
Yeah, and so I think there will be consolidation amongst the small REITs. We don't really invest in that space because we much prefer the bigger specialist REITs. So we don't invest in the smaller generalist REITs. We don't invest in smaller retail warehouse REITs, and there may be some mergers there, and you may be able to strip out some costs. But is that going to be a game changer to the valuation? You know, I don't think so. The portfolio of REITs that we own, I'm worried that PE is going to come along and it's going to pay a price that for the short-term investor they find acceptable, but for the long-term investor like Gravis, I find unacceptable. So, I mean, we're in this for the long term. It's a bit like Charlie Munger, Warren Buffett's right-hand man, said, you know, the big money is not made in the buying, big money is not made in the selling, big money is made in holding the good quality assets for a long period of time.
So you're an investor in industrials, I believe.
That's right.
What's your thoughts about that?
It's really sad to think that it will leave the listed market. Industrials REIT owns a portfolio across the UK of multi-let industrial estates. It's taken them many years to build up that portfolio. At the same time, they've created a fantastic digital front end. So the Hive platform that they've invested millions of pounds into, lots of man hours into. They've created a great brand. They've created a great operating platform. They have a great portfolio of assets, and we've just seen the documents come out for the bid, and the assets are being acquired at about a 12% premium to the last reported value. So on your side, you go, wow, the market's trading at 20% discount. It's getting acquired at 12% premium. That's a good trade. In the medium term, I don't think that's a good trade. Private equity, they're smart. They're profit hungry. They're not a charity. They're paying the bare minimum price to get this deal over the line. I prefer it to stay in the listed space, but to stay in the listed space, we need more investors to come in. We need more equity capital to come in to support the management teams to grow this alternative space. So I'd be disappointed to see it leave the market, because I think what we'll find out in the years to come, private equity will have made great money off this trade.
Yeah, and they're not coming in to give smaller return. But so Jason, you are one of the sort of generalist REITs on the small scale. Do you see consolidation between you and your peers?
Yeah, I mean, both my son and most investors tell me I'm deeply unfashionable. So generalist is a dirty word at the moment. You know, I like to think of us as diversified and full of opportunity. And I guess if we were equity, we'd call it unconstrained, maybe. We do have the ability to move into different sectors at different times. And there'll be some very educated investors who can spend a lot of time picking specialist funds. But particularly if you look in the alternative space, which is perhaps where there's been the most recent issuance and lots of growth in what I'd call sort of the alternatives, so maybe social housing, etc. But we've got quite a lot of problems. There's been a history of a number of these funds, which are very specialist, haven't had the same level of governance of a large fund management house. They don't move with times. They're driven into making certain decisions. So, I quite like generalists. I think there's some reason behind it for a lot of investors, not professional investors, so like Matthew, who can make educated choices and keep up to date and make all the changes for the big universe. Do I think there'll be some consolidation? Yes, because our investors are getting bigger and are demanding of it. Do I think it's going to solve half the problems? I'm not so sure. And because actually, if you look at the discount on the bigger streets, is it particularly different to the smaller streets? No. But consolidation seems to be flavour of the month, and I'm sure there will be some.
I think it's interesting. It's a really valid point you raise about just because it's badged alternatives, don't pile in and buy it. We've seen problems within social housing. So social housing, it's great. It's a noble cause, right? We need to house those people that are in some way disadvantaged, especially compared to us. That doesn't make it a great investment. And so I think some people just piled in capital into social causes and then have suffered sort of buyer's remorse and then thought about it afterwards. And it's like, wow, I didn't realize that the assets weren't top quality. So when we talk about alternatives, we're talking about these mega trends that are at play, but then we're looking at the specialist developers, owners, and operators of these assets. So whether it's Granger in the build to rent market, or Unite Student in purpose-built student accommodation, or Lock and Store in self-storage, they're all specialists in their area of alternative property.
If only we had Civitas on the panel to defend themselves. But yeah, so we've talked about student, we talked about a bit about self-storage as well. That mega trend, you talk about aging population. So what kind of companies and assets you talking about there? Care homes, healthcare?
Yeah, quite. So care homes and GP surgery. So as I mentioned, if you're over 85, fast growing cohort. If you're over 80, the stats show you that on average they see their GP 13 times a year. I mean, it's so you've got massive growing cohort that sees their doctor a lot, massive demand for primary healthcare. We know we've come out of the pandemic that our general hospitals are at a busting point. If you look at the data, if you go to see a GP in a hospital setting, it costs the NHS about £150. If you go to see a GP in a primary healthcare setting, it costs about £50. So we've got society, we need to invest more in primary healthcare. I think there's a consensus across the political spectrum to invest more money there. Who owns the most modern primary health assets? Increasingly the REITs, so the likes of Assura or PHP, they own the assets and then they rent them out to the GPs. These hubs, and increasingly hubs that do not just GPs, but they'll do diagnostics there as well. So outpatients appointments can be fulfilled there, so it relieves the pressure on the hospital. So I think that's one area to look at when we build the portfolio at Gravis. That's sort of the really stable part of our portfolio. So almost like government-backed income, very solid income, lower growth income. The other area of generation rent, care homes. So again, the pandemic really magnified the problem with the care homes. We have a problem in the general hospitals with elderly patients not being able to be discharged into care homes. We need to invest more into care homes, and I'm not talking just about high-end care homes, mid-market general care homes. So more investment into that. Who's going to do that? The REITs. The REITs will play their part. They'll own the building, and then they'll sign a lease with a care home operator that will sign a lease for 20 plus years linked to inflation. Now, unlike what we heard about continental Europe, it won't be uncapped. Those days are past, but still you'll get reliable income. at sort of 2 to 4%, 2 to 5% rental growth. So care homes, GP surgeries, really prime beneficiaries of an aging population.
So on a direct basis, I'd say it's quite difficult. So I've got some real concerns around care homes. That if my tenant is private equity backed, how much can they keep affording this annual increase in rent if they're not getting the patients coming in, if they're not operating well enough, getting the underlying growth? So we've seen it before. Very early in my career, I was selling distressed assets for Guardian who lent on them. One of them was a nursing home. And so I said to the guy, so what went wrong? He said, well, the trouble was all of my clients kept dying and I couldn't replace them fast enough. And at the moment we've got, obviously there's a shortage of spaces, but if you fall off the local authority list, etc., you won't be able to fill them up. So you've got to make sure you've got a really good operator, and buying in direct, that's a risk to me. So I don't want to be left as the owner of a care home and with an operator who's failing. And then across, what I really like the prospect of is senior living. So that stage before you go into the care home, but it's quite difficult to do it on a rental basis, and obviously as a REIT, income is really important. And I think until we can actually find a way of making that work, because generation rent hasn't yet got to 80. You know, the people who are in need of that type of retirement living at the moment, senior living, aren't really prepared to go down a rental model. And I think one of the great difficulties, and I think the Sunday Times had quite an interesting article a couple of weeks ago, about how much bigger your pension pot will need to be if you're generation rent to pay rent through your retirement. And you know, I've been just through it recently with my mother. I said to her, you know, she was moving up to be close to us. I said, why are you buying? Why don't you just rent? I mean, the stamp duty will cover your rent for probably as long as you're going to live. She said, well, the trouble is, I don't know how long I'm going to live. So it's very difficult to model that income basis at the moment.
That's really interesting.
So I mean, it's interesting because I mean, it's a new opportunity. I mean, I think Jason's right. Hasn't in this country we haven't solved that senior living piece of the pie, and certainly you know, every night in the UK there are houses in aggregate with millions of empty beds because you know, sort of like my mother's a widower and she lives in the family home, but the boys are no longer there. I mean, so there are these millions of empty beds when we have a housing crisis, but we haven't solved the senior living parts. When you ask about new REITs, could a REIT come along and solve that? Yeah, possibly. I haven't seen it yet.
Well, talking of new REITs, and you've got data centers here, and talked about that market. Surely that is a sector that's crying out for a REIT focused on data centers, like in the US and other countries. Is that fair?
Yeah, so look, at Gravis, we have a digital infrastructure income fund. So this digitalization megatrend that I talk about, we've gone global with it. If you go globally, look at the global REIT market, developed REITs, you can invest in tower codes, data centers, e-commerce fulfillment assets, and fiber optic networks. If you look at data centers, the amount of data that we capture, copy, and consume worldwide is just growing exponentially. I think one clear example of this, if you think about the photo taken on your smartphone, we will take gazillions of photos. We never delete them. So that's just the storage of data is growing. If you think about autonomous vehicles, when they come along, when we get chauffeured around by an autonomous vehicle, it's estimated that if you're chauffeured around for an hour in an autonomous vehicle, it's equivalent of using your smartphone for 1,000 or 2,000 years. I mean, it's a bonkers amount of data that's being captured, copied, and created. The problem in the UK, we don't have a way of investing in that. If you go global, then you can invest in the best-in-class owners in the States, things like companies like Equinix. If you go out to Asia, in Australia, NextDC. So these are real estate companies that we invest in own data centers. If you're looking at it, if you're a UK-based investor and you want to get exposure, there's either funds like the Digital Infrastructure Income Fund that we run, or a couple of other listed vehicles, but they're not pure plays on data centers. Seagrow owns the second largest collection of data centers in the world. It's on the Slough trading estate. But when you invest in SEGRO, most of what you're getting, and it's great, most of what you're getting is logistics assets, both urban assets and e-commerce fulfillment. So we're big fans of data centers. Private equity has been hoovering up the data center REITs. If you look at our digital fund since we launched it, it's only ever had 30 investments in it. We've had 6 or 7 of those acquired by private equity. They will come looking for more data centers. Do you see data centers in this space?
On a lease model, not very often. So it's mainly owner operated. It's obviously a specialist market. Increasingly, actually, what we're seeing is a shrinking of the investable universe because the location is becoming more and more specific as to where they've got the right data and increasingly power. I mean, I think perhaps the most incredible thing about this whole day is I don't think I've heard the word power yet. And I'd say that is probably one of the biggest influences of real estate over the next 15 years.
Yeah, I mean, Jason's absolutely right on the power argument. So data centers, massive consumer of power, consume about 2 to 3% of global power. So if we wanted to go and build a data center today, and you go to an electricity provider, wow, I mean, they're going to say that I'm rationing new connections. I've got a house builder, a home builder that wants to build 500 homes over here for your data center. I'd probably give the power to the house builder first. There are some countries around the world that have in the recent past had moratoriums on building new data centers because they're so power hungry. If we're in Hong Kong, Gravis invests in our Hong Kong listed owner of data centers. If you want to build a new data center, you can get power in 5 years' time.
So at the moment, there's a restriction on building residential in parts of West London for the next 5 years because they can't supply the power to it.
Oh, really?
Okay, so getting data centers is going quite difficult. We're actually looking at one solution to that, which is actually providing renewable energy and then developing around the provision. And actually, I was saying to one of my colleagues who's been looking at it, and he said, well, micro-nuclear is the way forward. He said, but our capital raising partners are looking slightly sort of white-faced when he said one of them costs sort of 8 billion. But if we could do 6, you can get them at a unit price of about 2.5 billion each. It's quite big money.
But if you own the assets, you're owning scarce assets. And I guess that's what we want to own. We want to own scarce assets where demand is high, and that supports future rental growth.
I mean, we could travel down this line of conversation for ages, but we are.
I thought you were going to raise the money for nuclear. Nuclear.
Yeah. Well, before we go to questions from the audience, I'm going to flip a question that you asked one of the other panelists earlier on to you about generation rent and government policy and rent control. Do you feel that is something that could be coming down the line in the UK?
It doesn't feel like it's coming down the line. So we saw the rent reform bill from the Conservative government yesterday. It's all about improving the relationship between, or giving tenants better rights and removing the threat of no fault evictions and that. So I think the relationship is improving. So the Conservative government would not introduce rent controls as far as I can tell. What do we see from the Labour Party? Well, is Sadiq Khan, Mayor of London, would like to have rent controls, but he doesn't have the power to do rent controls. We see in Scotland, so it's interesting hearing from the Scotland, when the power for rent controls was devolved to the regions, Scotland introduced rent controls, and as we heard from the panel this morning, hasn't worked. It's just meant that landlords have taken stock out of the market and sold it. Interestingly, Wales didn't introduce rent controls. But then there is a danger here. Look, we're finance people, we're broadly rational, so we think, okay, well, rent controls won't work, so the politicians won't do it. Well, if there's votes in it, they might do it. So it's definitely on my watch list. I haven't heard anything that leads me to think that rent controls are coming. There is a school of thought that says actually if rent controls came and they were at a decent level, then actually it wouldn't be a bad thing. But I think it it wouldn't solve the problem that we have. We have a housing crisis that we need to get new stock. We need to get higher quality stock into the market. Who's going to provide the higher quality stock? It's going to be the listed players. And there are 5 million renters in the UK, private renters, 5 million private renters. The vast majority of them are renting from amateur buy-to-let landlords. And some of them, unfortunately, don't have a great experience. Whereas the professional landlords are coming along with a higher quality product. So I'm not talking high end, but mid-market, but high quality of service. Rent control won't solve the problem. We need to encourage institutional money to come into this market, better this owner operator, better customer relations.
So I'm going to be contrarian and say yes. And I don't think it's necessarily a bad thing. And the reason I think we will have rent controls at some stage, within 2 years, no, but over a slightly longer period, I think quite possibly. And it's because of the amount of private landlords and the fact that they're not very good. You know, many of them have caused lots of problems. And actually, if you want to win an election, you do populist things. And populist thing doesn't necessarily involve being seen to help landlords, because landlords are greedy, capitalist, horrible people. And we've seen that time after time. So I think at some stage it will probably happen, because living expenses are going to be a major driver of personal wealth. And as we go away from home ownership, which effectively is a savings policy, when you take a mortgage out, you build equity and you retire with an equity pot. And we go through, for our generation, we've had quite good pensions. Yeah. I keep telling me I'm old today. You know, I look at my son leaving school now and starting a career. He won't have a good pension, particularly as his desire to be a ski coach. You know, he won't build up equity through home ownership. If you're paying most of your money in rent, how are you going to save? So I do think it is likely over time that we'll see some form of controls. Are rental controls necessarily bad? No. Because actually, if you look at Germany, where they've introduced some rent controls, etc., it's the largest rental market in Europe. So what you can't afford to do is have change. And where Scotland really went wrong, in my view, is they introduced something almost overnight without explaining it, without due warning, and without actually saying what's going to happen over time and giving consistency. So what they said at the time was, it's for a year, and after that we don't know what we're going to do. So as a landlord, you can't plan on that. You can plan, and land prices will adjust. Just as much can be built under rent control as without it, as long as you know the basis on which you can take a 10-year, 15-year investment decision.
Yeah.
So it's slightly, sorry, big controversial.
It
would be interesting to see what happens in Scotland, whether they renew it or whether they say, "Oh, blimey, that one didn't turn out the way we thought it was going to turn out."
Yes.
Yeah. Right. I think should we open it up to the room? If any questions of the panelists? Yeah.
Yeah, I was just wondering, thinking about the sort of mega trends, is what are the I guess opportunities where you really wish that you could invest in them today, but the investment opportunities just aren't there, and in 10 years' time you'll think, oh, if only I could have invested in this 10 years ago.
Good question.
That's what's out there in real estate that we can't get our hands on.
Co-living.
So we tried to launch. Gravis tried to launch a co-living fund. Unfortunately, we coincided the launch with Russia invading Ukraine, and investors didn't have the appetite for it. So, yeah, I think co-living could be interesting. Because if you think about generation rent, purpose-built student accommodation, graduate from that, where are you going to live next? Co-living could be a neat place to live. That could come along. I mean, because I certainly think the build-to-rent sector is going to continue to do very well. I don't really see any other alternatives that I wish we had a hand on those, because I think we've got good stuff. I think the danger is private equity keep coming along and buying it, so it shrinks. I mean, the risk is that purpose-built student accommodation shrinks even more if they come back into that market.
I'd say the two, and I've already mentioned them. For me, it's senior living. It's being able to crack a rental model for senior living so I can generate income. And I think it will come over time. And I wouldn't mind being able to find a way of accessing micronuclear or a good source of reliable power, because power is going to be the most important thing. I think.
Cool. Question?
I hear your concern about the REITs disappearing and private equity taking everything over. But from what the conversation we had at lunch, did you say your yields are just 4 or 5% a year for the investor?
Yeah, so if you look at the Gravis UK listed property fund, the blended yield right now is about 4%. The important point to note is it's growth income, not fixed income. So last year we grew the distribution by 12%. Inflation was 10. This year UK inflation is looking like it might be 7%. It's early to say where we're going to go our distribution, but it could be in the 5 to 9% range. So when private equity are coming in, they're coming in buying growth income assets.
And can I clarify, when you say who are your typical investors in a REIT? Because if they're baby boomers, they all know how to make at least 6%, 8% yield on a buy-to-let portfolio, even if they are bad. And your 4 or 5% isn't competitive enough. So how do you win over your new investors?
Yeah, so for our investor base, typically, it's IFAs, wealth managers, discretionary fund managers,
and their clients are usually baby boomers.
A variety of,
Tend to be,
of
because-
clients,
yeah.
and it fits into a balanced portfolio. So if you look at the academic research, REITs would represent sort of 8 to 12% of a balanced portfolio. So reliable income, growth income, and then if you want good returns. I mean, like private equity buy. I say that private equity are buying, everyone should be buying. This is a smart money buying.
I mean, because I'm in private equity, so I just couldn't see I'm trying to figure out a way to convince myself to put my money in a REIT, and I just don't see it.
The difference between the buy-to-lets is, so you might get a cash yield of 6, but you've got to manage that property.
No, I actually get a cash yield of 12, and I've got a very good tax structure in place. But private equity beats the REIT all day long. I think it's just the marketing of the REITs are not done well enough, because I never knew about it until much later, and I'd already put all my money in private equity.
Yes, on a generalization of private equity, I mean, the general model of private equity, the academics will show you that private equity is just leveraged public equity returns. And then when you drill down into real estate, who owns the best quality of real estate is typically the REITs. We haven't discussed this, but what's the big risk facing property? It's climate change. An earlier presentation was about showed the energy performance certificate ratings. So if you look at the kind of stuff that we invest in, 50% of what we own is already future-proofed, has an EPC and energy performance certificate rating of A or B, so it's future-proofed. If you look at the UK market as a whole, and I'm talking about commercial real estate, only 25% of it has an EPC rating of A or B. Someone out there owns a lot of real estate that is not future-proofed, that they're going to have to invest a lot of money in. So they might be getting a high-level yield right now, but that yield is going to be eroded by a requirement to invest more money into those assets to bring them up to a future-proof standard.
Can I also ask very quickly, to Jason, where does bridging finance come in? Because I pivoted from a lot of real estate portfolio. That's my pension, by the way, because I knew I had no chance. So I have that, and then I pivoted to bridging finance, which gives me 21% a year. And then I supply property to auction houses, and no leverage, no debt here. It's cash and cash purchases only. So how does bridging finance play in your investment portfolio?
So we just invest in direct real estate assets, and we use fund level leverage, which is sub 30% LTV. At the moment, it's very hard to have a creative leverage in real estate.
So would you consider bridging 100% on a distressed property which already has 25% equity on purchase? Because that's my model, and it seems to attract a lot of money. There's no leverage.
Well, I better have a chat with you then.
Yeah.
Try and work it out. Yes, I mean, look, we look at it. I mean, I guess as a REIT, what we're trying to do is distribute income. And so if it's a distressed asset with no income, that's difficult for a REIT.
I mean, income can be, it's a tenant, it can be tenanted. It's not a difficult thing. They're only residential, but it's just that there's no leverage. That's my key thing.
Okay.
But you don't do bridging right now.
No.
Okay.
Any other questions?
Yeah, hello. What do you think about these build completed properties tenanted, guaranteeing kind of return for 2 years or 3 years? What dangers could be associated with them? It's like students' properties, newly completed and tenanted, and the yield is guaranteed for a couple of years or so. Do you know about such?
It's not the type of thing that everything that we invest in is liquid and listed. So it's all listed on the London Stock Exchange, all trading. So we do like student property, but we invest in Unite Student. So it's the biggest owner and operator of student property in the UK. And there is no guarantee about what dividend you'll get from them. But if you look historically, they've done a fantastic job at generating shareholder returns. If you look at generation rent, if you look at rental apartments, again, we're investing in listed companies. They have a fantastic track record of generating returns for investors, but there is no guarantee return. But we prefer the listed space where it's the highest quality assets run by probably best-in-class management teams.
So Gravis, is it the same as VT Gravis?
Yeah, so
because I mean, you don't do trusts, do you?
So
you only do funds, is it?
So it is VT Gravis. So the funds that I advise on, VT Gravis, UK listed property fund, and the VT Gravis digital infrastructure income fund.
If someone gives you the word guarantee, that always frightens me. There's very rarely is there a guarantee 2 years something.
Yeah, but these are private developments.
Yeah,
not in the institutional. Just.
I think Jason makes a great point. Who's guaranteeing it? And
no, I mean they've tenanted it and they have a kind of agreements and with the tenants.
Certainly, one of the things I think is really important is not to think about the existing tenant and 2 years, but who's going to replace that tenant. So making sure you own an asset that's going to appeal to the next tenant as well, and then the next tenant will want to pay at least the same level of rent, if not more rent. So I wouldn't get fixated by someone telling me I've got a 2 year guarantee. 2 years is very, very short term.
Thank you.
Any other questions in the room? We got any online?
Yeah, I think it's a fairly general question. Talking about a range of alternative subsectors during the presentation. What does the panel think is the most exciting in terms of future performance of the alternative subsectors?
Right now, generation rent. I mean, clearly, we're going to see the fastest rental growth in generation rent in 2023 and beyond. Certainly within the build-to-rent sector and student population numbers. For each, if you look at the purpose-built student accommodation, for each of the next 10 years, we're going to have more 18-year-olds in the UK. If the same proportion of 18-year-olds go to university, increased demand for student accommodation. So I think the fastest rental growth we're going to see is in student accommodation. So you can buy it today with a good yield. You can buy it today with a good growth outlook.
I suppose I can't take student now, can I? But it is probably, I don't want to sound the most obvious. I mean, it's got great fundamentals, hasn't it? So, and the trouble with real estate is once we all agree, then it impacts pricing. It was much better sort of 40, 50 years ago when no one had research departments and there was much more disparate views. Today, everyone's a bit more coalescent. And we're going to move just sort of the next stage up the yield slightly. And I think service departments still quite an immature market, particularly in the UK. I think the mobility of people, flexibility, and actually sort of that stay from whether it's 3 nights to 3 months. I think that's quite an interesting market.
Cool. Right, well, thanks a lot for our panel. That's our time up, and we'll move on to the next one. But thank you.
Thanks very much.
Thank you very much. Thank you. Thanks very much.